Hello, class. In this part of the series, we are going to cover the most important concepts, the topics in economy section, and these are important from prelims point of view. So the first topic that I have chosen for you is this national income. Okay, in national income topic, we are going to cover various aggregates, related aggregates that we have. For example, GDP, GNP, and how those aggregates are different from each other. Then we will also come to know about various concepts which are very important from prelims point of view. Okay, so we will start this chapter by first understanding the most basic things. Then we will come to know that what is national income. Then we will also come to know that what are the different methods to measure national income. Then the agency which is responsible for measuring the national income, then the items which are included in the national income, items which are excluded from the national income measurement. So that is something which I have found that UPSC has been asking questions on this topic continuously, and this is going to be beneficial for you for your prelims preparation this year. Okay, so every time in this series that we are having, we are going to come out with basic concepts, and then we are also going to discuss some questions also, some questions that have come in your prelims examination, that have appeared in previous year prelims questions. So those are the things that we are going to cover. Okay, so let us start now. The first thing, the first concept here is gross domestic product. Okay, so many of the concepts that we are going to study here, you might be knowing these things already, but just to ensure that, because these concepts are very important, just to ensure 100% conceptual clarity, I'm not going to leave those things which are really important. Okay, so by the common understanding that you have about this concept, you can say that GDP is something that you can define in most simple terms as the monetary value of all the goods and services produced in a domestic territory. Okay, so here also you have the same definition, that is, it is the money value of all the final goods and services produced within the domestic territory of a country during a financial year. Now, in this definition, certain terms are very essential, and that have been those terms have been underlined. The first is that it is the money value of final goods and services. Final goods and services. Okay, produced within the domestic territory. So the second term here, which is important, is domestic territory of a country during a financial year. Okay, so three things we have to understand in this definition. The first is, it is the money value of final goods and services. So understand that goods and services can be of two kinds. Okay, can be of, one is final and the other is intermediate. Intermediate. Okay, now final goods can be of two kinds. The first is capital goods, and the second is consumer goods. Consumer goods. And what are intermediate goods? These are mainly raw materials. Okay, raw materials. So what we are including in the calculation of GDP, we are including the money value of final goods and services, and not the intermediate. These final goods and services. Okay, final goods and services. We avoid intermediate goods and services because they will again be used for the production of the final product. And if we account for those goods also, then that will lead to double counting. Okay, double counting. So if we start including these things also, these goods also, the intermediate goods, then they will be doubly counted. Okay, so in order to ensure that no product, good or service, is counted more than once, we ensure that GDP calculation includes only the monetary value of final goods and services. Those final goods can be capital goods or consumer goods. Capital goods means those goods which are used to manufacture the goods. Okay, so this essentially means machines. Now the second thing which is important here to understand, that produced within the domestic territory of a country. Okay. Now, domestic territory should not be confused with political boundary. Okay, so political, or if the production is taking place within the political boundary of a country, then that does not mean that it is going to be included in the calculation of GDP necessarily. No. So the term domestic territory is not synonymous with political boundary. Okay, so what domestic territory means? Here it has been defined. So domestic territory will include political boundary, but it will include other things also. So domestic territory includes political boundary, then exclusive economic zone of that country. Then it will also include embassies, consulates, okay, small diplomatic office, military establishment located abroad, and it is also going to be it is also going to include any income which has been earned in the international territory. So that can be the aircrafts, ships, fishing vessels, oil rigs. These are these things which are owned by the residents of the country. That means the income from the international territory. Okay. So what is included other than the political boundary of the country? That is something that you should keep in mind. Okay. So that is why I'm saying that the definition of GDP is easy, but for conceptual clarity, 100% conceptual clarity, you need to understand everything here. Okay, because they can ask questions on these things. They have been asking questions, conceptual questions on these things here. Okay, so for example, there is, say for example, US embassy inside the domestic territory of India. Okay, inside the domestic territory of India. Now, whatever production is taking place inside the domestic territory, inside the embassy of USA in India, that is not going to be included in the calculation of India's GDP. Okay. Similarly, if there is Indian embassy in USA, Indian embassy located in USA, then if there is production, then that production will be included in the calculation of India's GDP. Okay, so we are going to exclude the production that is happening in USA's embassy located within the political boundary of the country, and we are including the production taking place in India's embassy located in USA's political boundary. Okay, so this thing should be kept in mind, that these things are also included in the definition of domestic territory. It is not just political boundary. Okay, it is not just political boundary. So many places of production within the political boundary may be excluded, and many places outside the political boundary of the country might be included. Okay, so this actually completes your definition of gross domestic product. Okay, so finally it is what? It is the money value of all the final goods and services produced within the domestic territory of a country during a financial year. And you already know about the financial year, that it starts from 1st April to 31st March of the next year. Okay, so this is the most basic understanding of GDP. Now the next concept is GNP. Okay, and there also we are going to understand the basic difference, because these are most basic concepts. That is why I'm covering these things in first part of this series, and after that there will be some other important topics, important from prelims point of view. Okay, so let us see gross national product. We just saw gross domestic product. So what is different here? This term. So instead of domestic, we are having national. Okay, so gross domestic product accounted for all the production taking place in the domestic territory of the country. That included political boundary as well as other places. What about gross national product? It is the money value of all the final goods and services produced. So this is the same term, final goods and services, that you have already understood. All the final goods and services produced by the normal residents or nationals of a country during a financial year. Okay, so GDP was specific about where production is taking place. GNP is specific about who is producing. Who is producing? So here the production is happening by normal residents and national. Where it is happening, that is not our concern. Okay, so the concept of GNP, in the concept of GNP, what you have to keep in mind is this, that we are not concerned whether production is taking place within the political boundary or outside the political boundary, within the domestic territory or outside the domestic territory. We are just concerned that who is producing, who is participating in the production process. So here they are normal residents, or you can say nationals. Okay, in some text the term which has been given is national, in other text this term has been given. Okay, the most basic thing that should keep in mind is this, that you should not get confused between normal residents, nationals, and the citizens. Okay, so citizenship provides a legal status. So this is not actually imparting any legal status to an individual to demand or to claim certain rights which are available for citizens. So what I mean to say is this, that you must not confuse between normal residents or nationals and citizenship. Okay, so citizenship is a completely different thing. What about normal residents? So how do we decide that any individual is normal resident or national of any country? Understand, this simply means, normal resident or national simply means that it is an individual who usually reside in a country and whose long term economic interest also lies in the country. Okay, so it may happen that the individual is not residing in the country, but long term economic interest must lie in that very country. Okay, and again understand that when it comes to normal residents or nationals, then it pertains not only to individuals but also firms, organizations, or even the governments. Okay, so there can be a government company also whose long term economic interest may lie in any other country. Okay, so what is GNP then? GNP is the money value of all the final goods and services produced by the nationals or normal residents of a country. And nationals and normal residents of a country should not be confused, or you should not get confused between citizenship and normal residents or nationals. Okay, so whether the production is taking place within the political boundary or domestic territory or outside the domestic territory of a country, that is not the concern here. Okay, so when it comes to GNP, what is important? Whether the production is by nationals of a country or not. And when it comes to GDP, then it is all about whether the production is happening within the domestic territory of a country or not. Okay, if it is happening within the domestic territory of a country, then that will be accounted in the calculation of GDP. And when it is happening by the normal resident of a country, then it will become part of GNP. Okay, so I think that is clear. Now understand. We are going to understand this thing through an illustration, because in this illustration you are going to understand the most basic things here. Okay, so what I have done, that I have just drawn a political boundary of a country. Okay, and not only the political boundary, it includes everything that becomes part of domestic territory. Okay, so through this illustration many things will be clear to you. Domestic territory. So this is the domestic territory of a country, and outside this box lies the other places or rest of the world. Okay, now within the domestic territory of a country there will be certain normal residents or nationals of a country, and then there will be certain non-residents or nationals of non-nationals of the country who are not the nationals of that country. Okay, getting it? Now I have put three alphabets here: A, B, and C. Okay, so what is A? A is the income earned by normal resident from the domestic territory. Okay, so A, you can see here, is within the domestic territory of a country. Okay, then B is income earned by normal resident from abroad. So A is the income earned by normal resident, that is a national within the domestic territory. B is the income earned by normal resident only, but outside the domestic territory. And C is the income earned by non-resident within the domestic territory. Okay, so you must keep in mind that two concepts are here. The first is within the domestic territory and outside the domestic territory, and the second is normal resident and non-resident. Okay, now when you go for the calculation of GDP, gross domestic product, so there I just explained you that we are going to be concerned about the question whether the production is taking place within the domestic territory of a country or not. Okay, so let us see here. This is the domestic territory, and here I'm using the word income because every production process generates income. So you can use the term, or you can use these term production and income synonymously, because production will be equal to income. Okay, that is something that we are going to come to know later. Okay, so whether this production which has generated this much income is going to become part of GDP? Yes, because this is happening within the domestic territory of a country. We are not concerned whether it is happening by a resident or non-resident. If it is happening within the domestic territory of a country, then it will become part of GDP. Now, whatever is being produced within the domestic territory, that is going to become part of GDP. So here it has been written that GDP equals to A plus C. Why? Because A is the income earned by non-resident, normal resident, and C is the income earned by non-resident. But both is happening within the domestic territory of a country. Okay, within the domestic territory of a country. Okay. Now, what about GNP? When it comes to GNP as a concept, then we are not going to be concerned with the question whether the production is happening within the domestic territory or not. We are going to be concerned whether the production is happening by normal resident or not. Okay, so gross national product will account for, or it is going to include, all the production that is happening by the nationals of the country. So A is the income earned by national within the domestic territory. Definitely it will become part of gross national product. Then C is the income earned within the domestic territory by non-resident, and that is why it is not going to become part of GNP. Then B is the income earned, income not transferred. We are not concerned whether that person has transferred the income or not. No, income earned, that means the production. Okay, so B is the income earned by normal resident of a country outside the domestic territory, but because it is by the normal resident, that is why it is going to become part of GNP. Okay, so that is why it has been written here that GNP equals to A plus B. Okay, so I think both concepts are clear now. GDP will include everything that is getting produced within the domestic territory, and GNP will include everything that is being produced by the normal resident or the national of a country. And who are the normal residents? They are individuals, firms, organizations, governments whose long-term economic interest lies in the country. Okay. Now there is another concept here, and that is something that we are going to discuss now. And that concept is net factor income from abroad. Okay, net factor income from abroad. So it is nothing but income earned by normal residents outside the domestic territory, that is B. B is the income earned by normal resident outside the domestic territory, because this is the domestic territory of a country, and minus income earned by non-resident within the domestic territory. So income earned by non-resident within the domestic territory, that is C. So B minus C. B minus C. This is the net factor income from abroad. Net factor income from abroad. Okay. So why am I calculating net factor income from abroad? This is because we can get the value of GDP if we are given GDP if we are given with the value of GNP and NFIA, and similarly if we have given any of these two variables, then we can find out the value of third variable. Okay, how these are related with each other, that is something that we are going to understand. Okay, see what is GNP here, what is GDP. GDP is A plus C. This is GDP. And let us add NFIA here. NFIA is B minus C. Okay, so GDP is A plus C plus NFIA, and NFIA is B minus C. So what we get here, A plus C plus B minus C. What do we get here? A plus C plus B minus C equals to A plus B. Yes, A plus B. And what is A plus B? A plus B is gross national product. Okay, so what we can conclude here is this, that if we add NFIA with gross domestic product, then what we get? We get gross national product. Okay, gross national product. Okay, so we can say that gross national product equals to GDP, that is gross domestic product, plus NFIA. Okay, NFIA. How? GDP equals to A plus B, and we just learned NFIA is the income earned by resident outside the domestic territory minus income earned by non-resident inside the domestic territory. That means B minus C. Okay, so finally we get A plus B, which is actually the GNP. So what we are able to conclude here, if we add NFIA in domestic, we get national. Okay, so gross national product equals to gross domestic product plus NFIA. Okay, so we are going to study about national income, but there are various related aggregates that you must know. Okay, because they are asking question on these things also. One or two question is expected from this section of economy. Okay, now there can be GDP, then there can be GNP, then you can be provided with net factor income and any of these two variables, then you can be asked about the third variable, and this is the relation. Okay, so if you have to get domestic from national, then what you're going to do? You're going to subtract NFIA from national to get domestic. So in that case, it will be domestic equals to national minus NFIA. Okay, domestic equals to national minus NFIA. Okay, so you can say that GDP equals to GNP minus NFIA. Okay, so that is something that should keep in mind. Okay, next important thing here, inputs. Understand, again very important thing, and we are actually going to understand all the basic things, all the basic concepts which are important and are also going to help you to understand this national income in complete manner, in a very comprehensive manner, because that is important from PLIM's point of view. Okay, so there can be two kinds of input. The first is factor inputs and the other is non-factor inputs. Okay, now factor inputs are those inputs which are used in value addition. Value addition. And what are non-factor inputs? Non-factor inputs are actually those inputs which are used for the production. That is, for example, raw material. Okay, raw material. So on factor inputs, there is value addition which is done by factor inputs. On non-factor inputs, there is value addition which is done by factor inputs. Okay, so non-factor inputs are basically raw materials. Now, when it comes to factor inputs, there are mainly four kinds of factor inputs. Okay, first of all, why they are called factor inputs? They are called factor inputs because they are the inputs, they are the only inputs which can do value addition. Okay, no problem if you're not able to understand it. We are going to cover things in detail. So that is why just follow whatever is being explained here. Okay, so why do we call these things that we are going to understand factor inputs? Because only these inputs can do value addition. Only these inputs can do value addition. Okay, now when I say that these inputs can do value addition, then there is another thing that you should keep in mind, that whenever there is value addition, then only income can be earned. Okay, so you can say that factor inputs are called factor inputs because they can go for value addition, they can contribute in value addition. So that is why I'm saying that value addition can be done by factors only. What are these factors? Land, labor, capital, and entrepreneurship. And the second rule that you have to keep in mind is this, that income is generated only when there is value addition. So income, so these are the terms, very specific terms in economy, and that is why we need conceptual clarity. What is income? Income is nothing but, or income can be generated only when there is value addition. Only when there is value addition. Now, who can do value addition? Value addition can be done only by factors or factor inputs. What are these factor inputs? Land, labor, capital, entrepreneurship. Now, see these two rules here. Value addition can be done only by factors. And the second is income can be earned only by value addition. That means what? Can I conclude here that only factors can earn income? Can I derive this conclusion here? Yes, I can derive this conclusion because only factors can do value addition and income can be earned only by value addition. Then it can be concluded that factors alone can earn income. Why? Because factors alone can do value addition and income can be earned only by value addition. Okay, so what I'm saying here is this, that these are called factor inputs because they can do value addition, and only through value addition income can be generated, and that is why only factors can earn income. And these are the different factors and they earn different kind of income. So this factor earn the income which you can call rent. This factor, labor, earn the income which you can call wages. And this factor can earn income which you can call interest. This factor earns income which you can call profit. Okay, rent, wages, interest, profit. Understood? This is also going to be used in understanding the national income as a concept. Okay, so you just came to know that there are two kind of inputs. One is factor inputs, the other is non-factor inputs. And how do we distinguish them? Because factor inputs can do value addition, Non-factor inputs cannot do value addition. It is on the non-factor inputs where value addition is done by the factor inputs. Okay. The second thing that you came to know is this, that there are 4 kind of factor inputs which generate 4 different kind of income. Okay. And you also came to know that only factors can do value addition and only value addition can earn income, and that is why we concluded that only factors can earn income. Okay. Now these are different kind of income by different factors. Okay. Okay. Now, concept of national income and related aggregates. Understand that when we say national income, then it refers to a particular aggregate. But in order to understand that aggregate, that is national income, we need to understand other aggregates also, the related aggregates also, and they are important from prelims point of view in themselves as the concepts. Okay. The first is gross versus net. Gross versus net. Okay. Now, it is nothing but net equals to gross minus depreciation. That means if we subtract depreciation from gross, okay, from gross, then we get net. Okay. Which net we are talking about? When we use the word gross domestic product, then G here means gross, and gross in that sense actually includes depreciation. Okay. So for example, GDP as a variable is given, and you have to calculate NDP, that is net domestic product. Then what you will do, you will subtract depreciation from GDP to get net domestic product. Okay. So what is depreciation and why it has to be subtracted to find out the value of net? That is something that you can understand. Okay. So let us see. It is nothing but all the wear and tear, the reduction, the actually the consumption of fixed capital. Okay, consumption of fixed capital. Now, this consumption of fixed capital may come because of wear and tear, lapse of time, or you can say technological obsolescence. That is, any technology becoming obsolete with time. Okay. So whenever there is production process, understand the concept of depreciation fully. Whenever there is production process, it is the capital goods or some fixed capital which is involved in the production. Okay. So for example, in a production process, 100 crores worth of production took place. Okay. 100 crores worth of production took place. Now, the fixed capital, or you can say the machinery here that was involved in the production process, was also used. Okay. And there must have been certain wear and tear in that machinery also. So although it produced or it led to the production worth 100 crore rupees, but the machinery also underwent certain consumption because of wear and tear. So if you account for that wear and tear, and let us say that was somewhere around 20 crore rupees, then you have to subtract 20 crore from gross production in order to find out net production, because in the process of the production of worth 100 crore rupees, your machinery that was involved in the process of production also underwent consumption, or you can say there was consumption of this fixed capital in form of machinery, and that should also be accounted for to estimate the net production. Okay, so the gross production here was 100 crore rupees, and then you subtract 20 crore rupees, then you get net production. Okay, getting it? So in order to get net, what you do, you subtract depreciation from net. Okay, You subtract depreciation from net. Okay, so that is something that you should keep in mind. So for example, if you have been given gross national product, then how can you calculate net national product? You can calculate net national product by subtracting depreciation from gross national product, and this way you get net national product. Okay, so you came to know about two different concepts here that will generate different kinds of aggregates. The first is domestic versus national, and the second is net versus gross. Okay, in domestic versus national, what was important? Net factor income, NFIA as a concept was important. And here in net versus gross, what is important? Depreciation as a concept is also important. Okay, now understand that when we talk about depreciation, we are talking about consumption of fixed capital, and in more simple terms you can say consumption of capital goods. One example is this, that for example you are one employee working in a, so for example you own any particular factory, and every time when you go to that factory site, you use a vehicle, and while you are doing production, then your vehicle is also being used. Okay, you are using that vehicle to reach to that factory site. So when the production will take place, at the same time there is a consumption of your vehicle also. So your vehicle is also undergoing wear and tear, but we are not going to consider the depreciation in that vehicle. We are going to be concerned about the depreciation, that is wear and tear, in the capital goods, that is the machinery which is used in the process of production. Okay, why? Because we are concerned about the process of production, and your vehicle is not involved in the process of production. So it is the machinery that is producing the goods, that is manufacturing the goods, that is something that we are concerned about. Okay, so depreciation here is going to be reduction in the value of capital goods. Okay, the machineries that are going to be involved. So instead of using this may confuse you, that is fixed capital here, you can simply call it capital goods. Okay, so consumption of capital goods, that means in most simple terms it can be machines which are involved in the process of production. Okay, so understand these things. These are very specific terms, and you must have 100% clarity here. Okay, okay, so this is that you have already understood that in order to calculate national, you have to add NFIA, that is net factor income, in the domestic to get national. Okay, one good example is gross national product equals to gross domestic product plus NFIA. Okay, so this we have already understood in previous illustration also. Okay, NFIA. And what is NFIA? NFIA is, just for your revision, is the income earned by normal resident outside the domestic territory. Income earned by normal resident outside the domestic territory minus income earned by non-resident inside the domestic territory. Okay, so that is something that you call net factor income from abroad. Okay, so I think this difference is also clear now. Okay, let us see further. Next concept or the related aggregate, that factor that will bring difference in the related aggregate is factor cost versus market price. Okay, so how these two things are related here? Understand. Market price equals to factor cost plus NIT. NIT means net indirect tax. Okay. So whenever something is produced in the factory, okay, in any manufacturing site, then after production, certain indirect taxes are imposed, okay, in the production stage. Then it may also happen that certain subsidies are also given in the production. So what we say that in order to calculate market price, we add factor cost. And what is factor cost? Factor cost means cost incurred on those same factors that you just came to know about. Okay, cost incurred on factors: land, labor, capital, entrepreneurship. Okay, cost incurred on those factors plus indirect taxes, indirect taxes minus subsidies, minus subsidies. Okay, so cost incurred on factors, that is land, labor, capital, entrepreneurship, plus indirect taxes minus subsidies. So when you do this, you get MP equals to market price equals to factor cost plus indirect taxes minus subsidies. You can call it net indirect taxes. Net indirect taxes. So net indirect taxes would mean indirect taxes minus subsidies. Okay. Why? Because indirect tax is something that the producer is going to pass on to the customer. Okay. So for example, the factor cost was say 100 rupees. Then tax was imposed, which was 10 rupees. That is definitely going to increase the market price. The tax is going to increase the market price. Then maybe the government has subsidized that product also. Government wants that everyone should use that product, or something like this. Then it may subsidize that product. Say for example 5 rupees of subsidy was given, so that is going to reduce the market price. Understand? So it, this way you get 100 plus 10 minus 5, that is 105. Okay, so market price is being affected by tax. Here it was 10 rupees, and also subsidies. So indirect tax minus subsidy, you can simply call it net indirect taxes. Okay, net indirect taxes. And what is factor cost? I told you factor cost is cost incurred on factors. Okay, cost incurred on factors. Understand, you may think here that market price is being determined just on the basis of factor cost. Then where is the profit? Then you should recall that profit is already included in factor cost. So although we are using the term cost, but profit is included here. Okay, so there are two kinds of cost actually. The first is accounting cost, and the second is economic cost. So whenever you use the term cost, you generally use it for accounting cost. Okay, so here when we are using the term factor cost, when we say cost, we actually mean economic cost. So what is economic cost? Economic cost actually includes profit. So accounting cost plus profit equals to equals to economic cost. Okay, and again remember, I'll just take you back to that concept where we already discussed the factors inputs, and there you will see that this factor input, that is entrepreneurship, is generating profit. Okay, so factor cost is the cost incurred on factors, and these are the factors, cost incurred on factors, and one of the cost incurred on factor is profit. Okay, so this way you can say you can understand now that fact economic cost is different from accounting cost, and market price is going to be affected by factor cost, indirect taxes, and subsidies. Factor cost, indirect taxes, and subsidies. Okay. So what is market price? Market price equals to factor cost plus NIT. Okay. See, understand. We are using the term GDP. That is gross domestic product. And then there is GNP. That is gross national product. These are two different aggregates. This aggregate is relevant when we are talking about production in any country. So, for example, we are talking about India. Okay, India, Indian economy. Then GDP is an aggregate which is more relevant. But when we are talking about Indian nationals, then GNP as an aggregate is more relevant. Okay, Indian nationals may be residing within the domestic territory of a country, or they may be residing outside the domestic territory of a country. Okay, so when we are concerned about Indian nationals, this aggregate is more relevant. And when we are talking about India, that is the domestic territory, India, then this aggregate is more relevant. Okay, then we saw market price and factor cost. Understand that, for example, single aggregate, that is GDP, can be measured in terms of at factor cost, and it can also be measured at market price. GDP at market price. Okay, so how these concepts are, two aggregates are different. This is more relevant. This is more relevant when we are going to be concerned about growth, the calculation of growth. Okay, calculation of growth. But when we are concerned about the current transactions, then market price is relevant. Okay, now GDP at MP, if you are calculating the gross domestic product at market price, then that may have changed because of change in indirect taxes and change in subsidies. Okay, so while we go for the calculation of gross domestic product, we actually want to know of the actual value of production, that is a monetary value of all the goods and services produced in the economy. And if we are going to take into account the effect that is coming because of changes in the taxation policy, or because of some change in the policy whereby government is planning to give subsidy, then that is actually disturbing. That is actually not reflecting the exact amount or the value or the volume of production that has taken place. Okay, so in order to understand growth, in order to estimate growth, GDP at factor cost is more relevant. But for current transaction value, because this is happening in market price, GDP at market price is more relevant. Okay, GDP at market. So that is the difference that you should keep in mind. Okay, next. Then current price versus constant price. So what is current price? That means the value of goods and services at current year price. Okay, so ongoing year, that is the year when transaction is taking place. And what is constant price? Constant price simply means that we are considering any particular year to be the base year, and we are going to be concerned about the prices of the goods and services that prevailed in that particular base year. Okay, so there are two things. Understand, current price and constant price. So now you can have GDP at current price then GDP at constant price. Okay. So when GDP at current price will be calculated, then it is going to going to consider the money value of all the goods and services produced in the economy or produced in the domestic territory of a country. Monetary value will account for the current price, that means the price of that products in that particular year when transaction is taking place. And here it will be the price of those products in the base year. So we are going to consider any particular year, we're going to make any particular year the base year, and then we will account for the monetary value of all the goods and services produced in that country, produced in the domestic territory in that particular year by considering the prices of the base year. Okay, by considering prices of base year. So this is called nominal GDP, and this is called real GDP. Okay, the real GDP. So for example, the calculation of GDP at present 2011-12 is the base year. Okay, base year. So when we are going to calculate the real GDP in 2022, then we are going to be concerned about all the production of goods and services that took place in the year 2022. But in order to understand, in order to know the money value, we are going to see that what was the price of those goods and services that got produced in this particular year in the year 2011-12. So price that we are going to consider will be of 2011-12, and the production will be of this particular year. Okay, again, what is the relevance? Understand, so for transactional value, for the transactional thing, what is important? Current price. But in order to estimate growth, constant price is important, because if we want to know about the real increase in production of goods and services, then we should subtract or discount the increase in the price level. Why? Because the money value of final goods and services may change also because of change in prices of the products, although there may not be change in the production. Okay, and that is something that we are going to understand through an illustration. Okay, so this is the illustration. Understand that we are taking 3 years, that is 2011-12, then 2012-13, and 2013-14. Okay, so here you are going to understand the things completely. Now the unit of production that took place in the year 2011-12 was 100. Okay, so total production in 2011-12 in any country is 100. Then total production in 2012-13 is 100, and total production in 2013-14 is 150. Okay, 3 different years. Definitely the prices of these products, that is goods and services, in different years are going to change. They will change. So for example, current price. So what is current price? Current price will be the price in the year where transaction is taking place. So let us say in the year 2011-12 it was 10. Then 2012-13 it increased to 15, and 2013-14 price of 1 unit of production was 15 again. So in our example, what we are doing, we are going to consider 2011-12 to be the base year. Okay, base year. So when it comes to base year price, don't you think that if we know about the price that prevailed in the base year, and if that is 10, then it is not going to change? Yes, because if we are going to be concerned about base year price, then in 2012-13 also, because the base year is 2011-12, then we are going to consider the price that prevailed in the base year. Okay, so that is why it is not changing here. 10, 10, and 10. Okay, because this is base year price. Okay, now nominal GDP, that is GDP at current year price. Nominal GDP, that means GDP at current year price. So total production 100 and price of one unit of production is 10. So what is nominal GDP in the year 2011-12? Nominal GDP means total production multiplied by the money value, that is the price of unit production, that is 10. So it is 10 multiplied by 100. So 100 multiplied by 10 equals to 1000. So that is the nominal GDP in the year 2011-12. Nominal GDP in the year 2012-13. See here, again it will be the total production, that is 100 multiplied by the price that prevailed in that particular year. So price, that is current price that prevailed in that particular is 15. So that is why it will be 100 multiplied by 15. Although it is written here, it is wrongly written to be 1000. It is going to be 15 multiplied by 100, that is 1500. Okay, 1500. 1500. How we came to know about 1500? Price that prevailed in that particular year was 15 and total unit of production was 100. So 100 multiplied by 15 equals to 1500. Now again in the year 2013-14, nominal GDP was 2250. How? Because in that particular year, one unit of production, that price was 15 rupees and total production was 150. So it will be 150 into 15, that equals to 2250. Okay, so that is nominal GP. That is something that we are going to be concerned about, the price that prevailed in that particular year, that is the year of transaction. So here you just saw, understand that in the year 2011-12 the production was 100. Okay, total production was 100, and in the year 2012-13 again the total production was 100. Getting it? Now production did not change from this year to this year. Production did not change, but nominal GDP changed. From 1000 it became to 1500. Yes, from 1000 it became to 1500. There was no increase in the production, but there was increase in the nominal GDP, and that increase happened only because there was increase in price. Okay, so this is what I wanted you to notice, that nominal GDP changes or may change just because of change in price. So even though there is no increase in production, there is increase in nominal GDP because there was increase in price. Okay, and when it comes to real GDP, how do you calculate real GDP? You calculate real GDP on the basis of the price that prevailed in that particular in the base year. Okay, so for example, the real GDP in the year 2011-12, real GDP in the year 2011-12, production, total production 100. Okay, total production 100 and price of unit production in the year 2011-12, that is going to be 10. So 100 multiplied by 10 equals to 1000. In the next year, total production was 100, and price, we are not going to be concerned about price, because the price we are going to be concerned only with base year, and the price that prevailed in the base year was 10 rupees. So it will be 100 multiplied by 10, because when we consider base year, then there will be no change in the price. Okay, so whatever the price that prevailed in the base year, that is something that we are going to consider in the next year and next to next year, in every year, whenever we are going to calculate real GDP. Okay, so let us see, when there is no change in the production, 100 unit of production in the year 2011, 100 unit of production in 2012, then there is no change in real GDP. 1000 is the GDP here also, and 1000 is the GDP here also. Okay, so don't you think that we can conclude that the real GDP will change only when there will be change in production? It is not changing because there is change in the current price. Although nominal GDP is changing even when there is no change in the production, but there is change in the price. Okay, so again, understand that when we are going to be concerned about growth, I told you, then real GDP is the accurate aggregate, because real GDP will change only when there will be change in the production, because we are going to be accounting for the money value of the final goods and services produced in the domestic territory of a country by considering the prices that prevailed in base year. Okay, now from the year 2012 to 2013, 50 units of production increased, and here there is increase in real GDP. Okay, so because of increase in the unit of production, real GDP also increased. It did not increase when there was increase in the price and there was no increase in the production. Okay, so real GDP is increasing when there is increase in production. It is not increasing when there is increase in price. Okay, so that is why for calculation of growth, for in order to understand growth, this is the correct aggregate. Real GDP is the correct aggregate. Okay, so you just came to know about the difference between real GDP and nominal GDP. And through this illustration, you also understood that how these two aggregates are different and how these two aggregates are relevant in different manner. Okay, now let us see the next concept. The next concept is GDP deflator. Okay, GDP deflator. What is GDP deflator? Understand that firstly it is an index number. Okay, index number which measures inflation. Index number which measures inflation. The question arises that what is index number? Okay, so how can we define index number? Index number is nothing but an statistical tool, a tool in statistics. Okay, statistical tool to measure change in any variable. That variable can be price or population, okay, or any variable. Okay, so statistical tool. What is index number? Index number is a statistical tool which is used for measuring change in any variable. That variable may be price or population or anything. So GDP deflator in that sense is an statistical tool which is going to measure change in price. Okay, price. Whose price? Price of those goods and services which have been domestically produced. Simple. Okay, so what is GDP deflator? GDP deflator is an statistical tool which is used for measuring the change in the price level of those goods and services which are produced in the domestic territory of a country. Okay, now why we are studying GDP deflator? We just came to know about the difference between real GDP and nominal GDP, and now we can actually go for establishing the relationship among three variables, that is nominal GDP, real GDP, and GDP deflator. Okay, understand, when it comes to any index number, one good example of index number is here is GDP deflator, then there is a convention for writing that index number. Okay, so for example, CPI, consumer price index, wholesale price index, index of industrial production, these are all index numbers. So there is a convention for writing index number. Okay, convention is this, that if we want to express GDP deflator's value, then definitely in all these index numbers, any particular year will be made as base year. Okay, so for example, for measuring consumer price index, 2011-12 has been made the base year. Then how to express this index number? This index number will be expressed as follows. I told you that CPI is a index number. Now every index number has certain base year. And what I'm going to say here is this, that the value of any index number in the base year is always 0. Okay, so value of any index number in base year is always 0. Getting it? GDP deflator is an index number, and if we make 2011-12 to be the base year of index number, this index number, then for expressing the value of this index number in base year, we can write GDP deflator colon 2011-12 equals to 100. Okay, this is how we express the value of GDP deflator. So just for your revision, GDP deflator is an index number. What is index number? Index number is an statistical tool to measure change in any variable. So which kind of index number GDP deflator is? GDP deflator is an statistical tool which is used for measuring change in the prices of goods and services which have been domestically produced. Okay. Now, if this is how GDP deflator is expressed, then just go back to the previous table. And this is the column for GDP deflator. Then how can we write the value of GDP deflator here? Okay. In our example, 2011-12 is the base year. So the value of index number, any index number in the base year is always 100. So GDP deflator's value in 2011-12 would be 100. Yes, 100. Now what is GDP deflator? I told you it is the index number which is going to measure change in the variable, and that variable is price. So here it is going to measure the change in price. Change in price, when we are going to calculate the change in price, we are going to be concerned about current price, because base year price is not going to change. It is pegged at base year. Okay. So let us see. From the year 2011-12 to the year 2012-13, there has been 50% increase in the price. 50% increase in the price. Now, the base value is 100. So, the GDP deflator's value in the year 2012-13 would be 100 plus percentage change in the price. So, what is the percentage change in the price? Percentage change in the price is 50. So, here it will be 100 plus 50, that will be 150. So the value of GDP deflator in the year 2012-13 would be 150 rupees. Okay. Then from the year 2012-13 to the year 2013-14, price change, if you account for the price change, then it is 0. Okay. So price change is 0. That is why GDP deflator will also remain same, and there will be 0 change. So 150 in the year 2012-13, then again 150 in the year 2013-14, because there was no change in that variable which we are measuring, that is price. Okay, so you came to know about nominal GDP, you came to know about real GDP, you came to know about the significance that these two terms have. Then you also came to know about GDP deflator. GDP deflator. Okay. Now, finally, I am going to tell you about the relevance of this particular concept, why I included it here. Because we can establish a relationship between or among, you can say, these three variables, that is real GDP, nominal GDP, and GDP deflator. So that relation can be expressed something like this: real GDP equals to nominal GDP minus or by GDP deflator into 100. This is the relation that I'm talking about. Okay. Okay. So real GDP equals to nominal GDP by GDP deflator into 100. And now you can see here, if you have nominal GDP and the value of GDP deflator, then you can calculate real GDP. That is 1000 by 100 into 10. Okay. So that is something that you can calculate on your own. Into 100. Next, national income. Okay. So that was our first slide. And then we are again coming back to this slide. Okay. The same term. So we started with this national income as an aggregate, but somehow we studied other aggregates, for example, GDP, GNP. Then we also studied those factors which bring changes in those aggregates, that is factor cost, market price, current price, constant price. Okay, domestic, national. Then what is national income? Is it equals to GDP or GNP? Which particular aggregate actually denotes national income? So just for your information, you must know that when we use this term national income, we are talking about a particular aggregate, that is net national product at factor cost. Okay, net national product at factor cost. This is what we know as national income. Okay, so when we account for or when we go for the measurement of national income, that is not GDP at factor cost, that is not GDP at market price, that is not GNP at factor cost or market price, that is NNP, that is net national product at factor cost. Okay, so what is national income? National income is net national product at factor cost. Net national product at factor cost. Okay, net national product at factor cost. Now understand that if we have been given with this aggregate, that is GDP at market price, that is definitely not the national income. That is not the national income. Okay, then how can we go for the calculation of NNP at factor cost? NNP at factor cost, that is national income. Understand? Okay, so we have this aggregate and we have to get this aggregate. So how to get net national product at factor cost from GDP at market price? So we will go to from this to this piece in a piecemeal manner, one by one. Okay, so here it is gross and here it is net. So how to get net from gross? What we are going to do? We are going to subtract depreciation. Yes? Yes? We are going to subtract depreciation from gross to get net. Then here it is domestic and here it is national. Gross domestic product. Here it is net national product. So how to get national from domestic? What we do? If you have paid full attention, then I told you that we add NFIA in domestic to get national. So we subtract depreciation from gross to get net, and we add NFIA in domestic to get national. Then it is P, here also it is P. Then from market price to factor cost. Okay, what we do to get market price from factor cost? We add NIT in factor cost to get market price. Now we have been given with market price how to get FC. We are going to subtract net indirect taxes from MP to get FC. Okay, so if we have been given with this aggregate, that is gross domestic product at market price, then we can get net national product at factor cost by subtracting depreciation, adding NFIA, and subtracting net indirect taxes. Okay, so that is something that you should, and that should be clear to you 100%. Okay, now this is the illustration that I have taken, and now this illustration I will use to make these things clear. This will also be used while I'm going to explain the measurement of national income. Okay, so what I have done here is that I have taken a case of production of any particular pen, say. So, okay, a pen got produced, manufactured in an economy, and just for the sake of understanding, I'll simplify it and I will say that only this pen got produced in that economy. Only this pen got, one thing got produced in that economy, and that economy is not interacting with outside world. Okay, so that means you can say that there is no net factor income that is coming to that economy. So that means net factor income from abroad is zero. That is what I mean here. Okay, so if I say that only this pen got produced, and this is how the things were used, that is the value of non-factor input, that is raw material is 5. Then factor inputs, that means rent, wages, interest, profit, that was 15. Then if there is production, then there must have been certain consumption of capital good, that is a machinery that was used for manufacturing this pen, and let us say the depreciation was worth 1 rupee. And then there were certain indirect taxes and then subsidies. So final net indirect tax was 4 rupees. Okay, final indirect tax was 4 rupees. Now, if you have to calculate the price of this product, then we are just going to add up these things. So 5 plus 15, that is 25. Again, we are going to add depreciation, because that is a consumption of the fixed capital, that is a machinery that was used for pen. Then again we are going to add 4. So this is the final price of the product, that is 25. Okay, final price of the product. Okay, now I'll just make sure again that you must understand the concept of GDP completely. Okay, so although we have studied about the definition, and in that definition what I said, that GDP is the money value of all the final goods and services produced within the domestic territory of a country. And through this illustration, I'm going to tell another fact about GDP, that is in calculation of GDP of a country, Although we are concerned about the money value of final goods and services produced in the economy, but in that calculation, the value of non-factor inputs is not included. Okay, so value of non-factor input is not included because GDP actually is nothing but the addition of all value addition that has taken place, or the summation of all the value addition that has taken place in the economy. That is gross value addition that has taken place in the economy. Okay, so gross value addition that has been taken place in the economy, that is what we know as GDP. Okay, gross value addition. So there will be different gross value additions in different sectors, and if we go for the summation of gross value addition in different sectors, we get GDP. Okay, and what is gross value addition? Gross value addition means value of output minus value of non-factor input. Okay, the value of output here is 25 minus value of non-factor input, that is 5. This will give you the value of GDP. And it will definitely be the GDP at market price because we are not subtracting the NIT here. Okay, that is net indirect taxes. So, just for your revision, I told you that GDP is the money value of all the final goods and services produced within the domestic territory of a country. But then I told you now that GDP, while we go for the calculation of GDP, we are not going to consider the value of non-factor inputs. We are actually concerned about all the value addition that has taken place in the economy, and that is why GDP at market price, you can say, is actually the summation of gross value addition that has taken place in every sector of the economy. Okay, so that is why I needed this illustration, that you might be tempted to say that GDP at market price here, it will be 25 rupees, and that is why I needed to explain that GDP here will not be 25 rupees, it will be 20 rupees. So GDP at market price here will be 20 rupees because the value of non-factor inputs is not going to be included. The value of raw material hai yahan pas. This is raw material and that is not going to be included. Okay. So don't get confused. You have already studied about the proper definition of GDP. And now you have come to know about another facet of this concept, that it is not going to be concerned about the value of raw material. Okay. So although we say that is the money value of all the final goods and services produced in the economy, it is actually not going to include the price or the cost of raw materials. Okay. It is going to be concerned about all the value addition. And how to calculate the value addition? That means gross value addition, that means the value of output. Here it is, the value of output is 25 minus value of non-factor inputs. So 25 minus 5 equals to 20 rupees. So that is why it has been written here, the GDP MP, that is GDP at market price, equals to 20 rupees. Okay, GDP at market price equals to 20 rupees. Okay, GDP at factor cost, here it is 16 rupees. How? Because in order to get factor cost, what we do? We subtract NIT from market price. So 20 minus NIT. NIT here is 4. So 20 minus 4 equals to 16. So GDP at factor cost equals to 16. Okay. GDP at factor cost equals to 16. Okay. Now if you have understood all this, then in this illustration, what is the national income? What is the national income? Okay, I took an example where I said that only this particular thing, that is this pen, got produced in the economy. Okay, national income, you already know that it is net national product at factor cost. Okay, net national product at factor cost. You know about the GDP at market price. So GDP at market price is 20 rupees. Now you have to get net national product at factor cost. So what you are going to get, how you are going to get net national product at factor cost from GDP. From gross, you have to get net. What you have to do? You have to subtract depreciation. Then from domestic, you have to get national. That means you have to add NFIA. And from market price, you have to get factor cost. That means you have to subtract what? You have to subtract NIT. Okay. So in our case, depreciation was -1. So 20 minus 1. Then NFIA in our case is 0. That means plus 0 minus NIT. That means NIT in our case is 4. That means minus 4. So here it is 20 minus 1 plus 0 minus 4 equals to 15. So here in our case, in our example, net national product at factor cost, that is national income, is 15. Okay, is 15. And now recall the definition of factor inputs. What was the definition of factor inputs? The definition of factor inputs was that they are called factor inputs because only those inputs can do value addition. And the second rule I told you, that it is only through value addition that income can be earned. Okay? And who can do value addition? Factors alone can do value addition. And how can we generate income? Only by value addition. And that is why we concluded that only factors can earn income. Only factors can earn income. Understand what is the conclusion here? That is very much clear in this illustration also. That is, the factor inputs was rent, wages, interest, profit. That means different kind of income generated by different kinds of factor inputs, that is land, labor, capital, entrepreneurship. Okay, so when we went for the calculation of national income, what we actually accounted for? We accounted for the income made by the value addition by the factor inputs. Here it is 15, and see how we arrived at this particular digit in our calculation also. Okay, so factor inputs, that is rent, wages, interest, profit, these were the only income generated in the process of production. So there are non-factor inputs, then factor inputs, depreciation, NIT and all. But the income was generated only by the value addition which was carried out by these factor inputs, whose worth was 15 rupees. And that is why you have national income equals to 15 rupees here. Okay, national income equals to 15 rupees. Okay. Okay. So what is national income? That is, what is net national product at factor cost? It is the income earned by normal residents or nationals during a financial year. Okay, so this is the definition now. Net national product at factor cost. So it is the total factor income. Factor income, you understand the meaning of factor here. Okay, factor income means income generated by factors. That is the total factor income earned by normal residents or nationals during a financial year. Okay. For prelims point of view, every concept that we just discussed is important, but also important. What is also important is these terms. Okay. Here it is being said income earned. I'm not saying income transferred. So there may be a non-resident, there may be a resident of a country residing outside the territory of India, and that person is generating income. So it is going to become part of national income whether he send it back to India or not. Okay, if it is being generated by national, then that will become part of national income. Okay, so whether he send that, whether he transfer, or whether he remits that income or not, that is not the purpose. Okay, it is being earned by normal resident. Okay. Second is, when it comes to net national product at factor cost, what we do? We actually subtract depreciation from gross. And that is also something that I need to highlight. that why I need to highlight is why I need to highlight it. The reason is that in any production process there will be certain depreciation, but national income is not going to be, or income is not going to be affected by depreciation. Income is not going to be affected by depreciation. For example, if any employee is working in any factory, okay, any employee is working in any factory. Now if you go for the net production in that particular factory, then you will account for the depreciation. But income per se is not going to be affected by depreciation. Income is not going to be affected by depreciation because that individual is working in that particular factory, and that factory employs various individuals who are earning salaries, and those salaries are not going to be affected by the consumption of the machinery there. Getting it? Getting it? So that although that production process is consuming the machines, but that is not going to reduce the salary which is being earned by the employees in that particular company. Okay, so that is also something that you need to keep in mind. Okay, so what is national income? It is the total factor income earned by normal residents, nationals, during a financial year. Now the next term is domestic income, that is the total factor income earned in the domestic territory of a country during a financial year. Domestic territory of a country earned during a financial year. Okay, so again we'll remind you the same thing that we already understood in previous aggregates, that when we are talking about India, then it is a domestic income uh, which is relevant, and when we are talking about Indians, it is the national income which is relevant. Okay, it is the national income which is relevant. Again, for domestic income, we are not going to um, be concerned about depreciation. We are not going to include depreciation in national income. Getting it? Why? Because again, understand, or domestic income, understand that income is not going to change because of depreciation. Because of depreciation. So that is why we are not going to include depreciation. Getting it? Now, measurement of national income. Understand that Central Statistics Office in your country, CSO, is responsible for measurement of national income through National System of Accounts, NSA. Okay, so it is a CSO, the organization which is responsible. Now there are various ways to measure income. Okay, and there are actually three ways, and why these three different methods or ways are adopted, that is also something that we are going to understand. Okay, so first is income method, then there is expenditure or production method, and finally there is expenditure method. Okay, so why these, there are three different ways or different methods of measurement of national income? Understand, we had income method, then production method, then expenditure method. Understand, every production I told you is going to generate certain income. Every production is going to generate income or equivalent amount of income. And if you account for the whole economy, then definitely the expenditure is going to be equal to income. So whatever income you are going to generate, or you will be able to spend, or your expenditure is going to be decided by income only. So production, every production process generates income, equivalent amount of income, and expenditure is going to be equal to income only. Okay, going to be equal to income only. Now, in different sectors of economy, for example, you have different sectors. You have agriculture sector, primary sector agriculture, which includes agriculture and allied activities, which is primary sector. Then there is secondary sector, which includes manufacturing, then electricity, construction, construction, and then tertiary sector, which includes services. Okay, it also primary sector also includes mining and quarrying. So I told you that there is income method, then there is expenditure method, then there is production method, and then there is expenditure method. Now, in different sectors of economy, that is primary sector, agriculture, allied activities, mining and quarrying, manufacturing, electricity, gas, water, all that comes in secondary sector. Then tertiary sector generally includes service sector. In different sectors of the economy, different kinds of different methods are used for the calculation of national income, because it is only through different methods we can go for the calculation of the final value of output, of the final value of production. Okay, so for example, when it comes to agriculture sector, when it comes to agriculture sector or allied activities, then mining and quarrying, then electricity, gas, water supply, in all these sectors we cannot go for income method. Why? Because that is not certain in every case. We also cannot go for expenditure method, because the same product may ask for may require different level of expenditure in different regions. What we go for is the production method. Okay, production method. Similarly, when it comes to construction sector, we cannot go for production method, because we cannot have a proper estimate of the value of all the things that got produced in any particular building or any particular site, in any construction site. Okay, so what we do, we go for the expenditure method. So whatever money has been used to purchase that particular building, say that constructed building, then that will be the final value of that particular building. So we go for the expenditure method in construction. In service sector, we go for the income methods, because it is easier to find out the value of services that got produced by measuring the income. Say income of a doctor, income of an engineer, software engineer. Okay, income made in the hospitality sector, in the health sector, in education sector. Okay, so this is how, because different sectors of the economy have different kinds of economic activities, and those economic activities require different kinds or different methods of estimating the final value of all that got produced, and that is why we have different methods of measuring the national income. Okay, so the first is income method. What is income method? It is simply the addition of all the income that has been made by factors. Okay, so it is going to include rent, wages, interest, profit. Okay, so just for more elaboration, rent here will also include royalty. Okay, here rent is going to be on physical capital and royalty will be on intellectual capital. Wages and salaries. So for salaries, you do not have the different classification. That is also in the same category, that is wages and salaries. Then interest, and then profit. Interest is made on capital and profit is made by entrepreneurs. Okay, sometimes mixed income of self-employed, sometimes it is kept as a separate category. Otherwise, mostly what happens, that this particular item is classified among these four. Okay, so sometimes it can be wage, sometimes it can be rent, sometimes it can be interest, sometimes it can be profit. Okay, so this can be kept as a separate category. The fifth item can be kept as a separate category, or it can also be kept as a part of these top four items. Okay, so income earned in form of rent and royalty in the domestic territory of a country, then income earned in form of wages and salary in domestic territory, then income earned in form of interest, then profit, and then mixed income of self-employed. Understand, this is going to give you the idea about domestic income. Domestic income. Okay? Because we are not including anything which has been, any income which has been generated outside the territory. So this is going to be domestic income. This whole will be domestic income. And in order to get national income, what we do? We add NFIA. So through this we get domestic income, and when we add NFIA, we are going to get national income. Okay? We are going to get national income. Now go back to your illustration. This was illustration. So rent, royalty, wages, salaries, interest, profit, and income of self-employed. That is the domestic income. That is this particular income, domestic income. So 15 plus NFIA is going to give you national income, plus NFIA in our case is 0. And that is why national income in our case is going to be 15. We have already calculated it. Okay, we have already calculated it. Okay, so you just came to know about income method. Income method. Okay, income method. So income method gives you this domestic income as an aggregate. Then you add NFIA here, add NFIA to get national income. Okay, second method, production method or value added method. Value added method. So what we are going to calculate here is the value addition. National income is estimated by adding up value additions by all economic entities. That means value addition done in every sectors of the economy. Okay, every sector of the economy. And how can we go for the estimation of value addition? We can go for the estimation of value addition by this particular formula. That is the value of output minus the value of non-factor inputs. Non-factor input. Value of output minus value of non-factor input. So in that illustration, the value of output was 25 rupees, and value of non-factor input, just look at your copy, and it was 5 rupees. And this is going to give you the gross value addition at market price. Gross value addition at market price. So value added equals to value of output minus value of non-factor input. Here it is written it is non-factor input. Value of output minus value of non-factor input. Non-factor input. That means in our illustration it would be 25 minus 5 equals to 20, and that will give you the value of gross value addition at market price. Gross value addition at market price. And you already know that the summation of gross value addition at market price equals to GDP at market price. So what is the calculation here? 20 equals to GDP at market price. GDP at market price. So this we came to calculate. So after calculating this, GDP at market price equals to 20. This is summation of gross value addition. And how can we get net national product at factor cost? By from gross to net, we have to go for depreciation. Subtracting depreciation from domestic to national, we have to add NFIA. And from MP to FC, we have to subtract NIT. So we have to subtract NIT. So 20 minus depreciation, how much? 4 plus NFIA, that was 0, minus NIT. Depreciation was 1 and NIT was 4. So 20 minus 1 plus 0 minus 4 equals to 15. Just go back to your illustration. Again, through production method also, what we came to know that the national income is finally 15 only. National income is finally 15 only. Okay, so from GDP MP that we get by the summation of gross value addition, we get national income, that is net national product at factor cost. So this is how you calculate national income, okay, through production method. So if you go to the same illustration that we took while starting our discussion on national income, then you can go for the calculation of national income in that illustration also, and that will be 15 rupees. Okay. Finally, the third method is expenditure method. Okay. So from PLIM's point of view, what is needed is a crystal clear concepts or the understanding with comprehensive understanding of every topic, every concept, and also understanding the nuances. Sometimes UPSC is going to confuse you with different terms, and that is why every time I'm going to highlight it, okay, because uh, they may confuse you by, say, for example, if I use the word income earned, so they can use the word income transferred. So that is also going to change the meaning of the statement. So that is something that you have to keep in mind. Okay. So expenditure method. So what is expenditure method? It is going to include or add or aggregate all the expenditure on final goods and services, expenditure on final goods and services. And because it is the expenditure on final goods and services, it is actually nothing but production method. Why production method? Expenditure on final goods and services would mean what? Expenditure on final goods and services would mean expenditure on output minus expenditure on input. Yes, expenditure on output minus expenditure on input, that will give you the expenditure on final goods and services. So for example, expenditure on final good would mean expenditure on final output minus expenditure on whatever material has been used for manufacturing that final good. Okay. So expenditure on output means what? It will simply the value of output minus expenditure on input, that is the value of non-factor input. So that is why I'm saying that the changing the method is not going to change the number. Getting it? Now for this method we have a different formula here. This is the different formula. So y equals to c plus I plus g plus x minus m. This is the formula to get the value of final expenditure on final goods and services. C means private final consumption expenditure. G means government final consumption expenditure. I means expenditure on capital goods. Here it is consumer goods. Okay. So expenditure on capital goods, and I would include the expenditure made by private as well as government. X means exports, that is the expenditure. Exports minus M, that is imports. Okay. So whatever we import, we do kind of expenditure only. And whatever we export, the other countries actually do expenditure. So whatever expenditure we have on imports, we are going to subtract that whatever expenditure foreigners have on your export. Okay. So that is how you get the aggregate expenditure. Now understand, I told you that in the calculation of national income and related aggregates, raw material is not used. And that is why I'll just remind you that in this case, if we are exporting, say, for example, raw material, will that be included? If we are exporting raw material, will that be included in accounting national income? Yes, that will be included, because if we are exporting raw material, then from our end, that is the final product. Okay, from our end, if India is exporting, say, iron ore, then iron ore is going to be used for manufacturing steel. If it would have been the domestic territory, then that iron ore is not going to be calculated, because that is going to be used as raw material for the production of final good, that is steel. But if you are exporting raw material, then that will be included in the expenditure, that will be included by the expenditure made by others in your item, Because according to India, because from India's point of view, that is the final good. Okay, from that is the final good. Getting it? So this is the expenditure method. That is something that you have to keep in mind. The second thing is this, that when we go for expenditure method, we are doing X minus M, that is the expenditure by outsiders in your uh, thing, in your products and services that you have exported, minus your expenditure on the things that you have imported. X minus M should not be confused with NFIA, that is net factor income from abroad. Okay, it is X, that is import minus export, is not NFIA. That is not the case here. Okay, it is also not trade deficit, because trade account is going to include the export and imports of goods only. Okay, it is going to include trades of merchandise only, but here it is the export and import of goods as well as services. So X minus M is neither NFIA nor trade account. Okay, or you can say current account. X minus M is neither NFIA nor it is trade account. Okay, it is closer to a current account. Then finally, within this particular method, you must come to know that this calculation, this particular formula is going to give you which kind of aggregate. So which kind of, whether it will be gross or net. It will be gross because in no way, in nowhere we are going to subtract depreciation. So that is why it will be gross. Then it will be domestic or national. Definitely, if we have accounted for the subtraction of imports from exports, then it is national only. So it is domestic only. So that is why we are saying gross domestic, and definitely it is product. Whether it will be at factor cost or market price, all the transactions are happening at market price only, and that is why it will be GDP at market price. So what this formula is giving you, this formula is giving you this aggregate, that is GDP at market price, the same aggregate that you got in case of production method or value added method. Okay, output method. So in production method, you got the value of GDP, and then you calculated the value of NNP at factor cost. Okay. So similarly, through this formula, you get the value of GDP at market price, and from here you can calculate the value of net national product at factor cost, and this is what you know as national income. Okay. So this is the third method of measuring the national income, and this is the way to do it. Okay. Finally, items which are not included in the calculation of national income. So this can also become a question, okay, because this is conceptual. Then you know that intermediate goods are not included. So for example, raw material and all this is not included because that will lead to double counting. Then transfer payments, that is unilateral payment without any consideration, that is also not included. So for example, gifts, grants, donations, these are unilateral payments uh, which are not made for any consideration. That means, for example, remittances, these are not included, they are unilateral payments. Then windfall gains. Windfall gains means, for example, you won something in lottery or in any quiz contest, all that is not included in calculation of national income. Then sale and purchase of second hand products. Okay, again, sale and purchase of second hand products, why this is not being included in the calculation of national income? Because they have already been included. If we are going to include again the sale and purchase of second hand products, then that will lead to double counting. But in this case, you must remember that broker's fee, okay, broker's fee is calculated. So for example, if there is a deal of second hand products and dealer is actually mediating that deal, any particular dealer is mediating that deal, and dealer is charging a fee for that, then that fee is going to be included in the calculation of national income. Why? Because even though it is a second hand product, but that dealer's service, the broker's service, is being generated first time for this particular product. Okay, so it is a new service which got generated in the sale and purchase of second hand product, and that is why broker's fee even in the sale and purchase of second hand products is going to become part of national income. Then black money is not included. Actually, it's we should say that black money can't be included because it is unaccounted money. And then how can we go for calculation of national income? How can we include national income because we don't have any account for it? Okay, then capital gains. For example, you're holding gold in your at your home. Then if there is increase in the price of that gold, that is not going to make any additional income or will become part of national income, because increasing the price increase in the price of any particular asset is not going to increase the income. You know that how income is generated in the economy. It is generated only when there is value addition, and value addition can be done only by factors. Okay, then household services, for example, services delivered by housewives, that is also not included. Okay, so these things are not included in national income. For example, transfer payment would also include things like old age pension. Okay, old age pension, although pension is included because pension is given to a person because he or she has delivered certain service. Okay, but old age pension is like transfer payment. Then items which are included in national income, that is something that need to keep in mind. Okay, so for example, items value of self-consumed goods. So I give you an example that there is a farmer, and that farmer produced say 10 kg of wheat total. Okay, 10 kg of wheat. He self-consumed. He actually consumed this 3 kg of wheat and could sell only 7 kg of wheat in the market. So the question is whether that 3 kg of wheat which farmer consumed himself should be calculated in national income. Yes, it is calculated in national income. Okay, so value of self-consumed goods is calculated in national income. And the second thing is this, that estimated or included rent of the self-occupied property. Okay, so one may be living in his own property, might not be giving rent to any other person, but it is understood or it is taken as if he is giving rent to himself only. Okay, so estimated or included rent of self-occupied property. So that is included in the national income. Okay, understand one thing here. There is kind of anomaly, and that is something that you should take note of. Value of self-consumed goods is included in the calculation of national income, but value of self-consumed services is not included. Okay, so value of self-consumed services, that is not included. Okay, so that is something that you have to keep in mind. Value of self-consumed good is made part of national income, but value of self-consumed services is not made part of national income. So this was all that we need to understand in national income chapter. So in the next part we are going to do certain questions, and I hope that every concept in this particular topic is now crystal clear to you, and this is important. You might be able to understand, or you might be knowing that this particular topic is important, and UPSC has been asking question on this particular area almost every year. Okay, in the next part we are going to do certain questions, and we are going to pick certain very important topic from prelims point of view. Thank you very much. Thank you.